If you have ever felt a little bit uneasy about your financial future, you are not alone, according to a recent study released by Allianz Insurance Company. The numbers are pretty alarming. 67% of Americans say they fear running out of money more than death, and 57% say they feel anxious when the market drops. Think about that for a second. More people are afraid of running out of money than they are of dying. That is not something that we should brush off. And these two stats, they are kind of the same problem showing up in different ways. Because when you do not know what your plan can support, how much you can safely spend, or what happens when the market goes down, every drop in the market feels like a threat to your security and to your livelihood. It feels like this might be the thing that breaks your retirement, and that is where that fear creeps in. When it feels like your future, your financial future, is tied to something outside of your control, whether that is the market, the economy, or the headlines. So in this video, I want to do something very specific. I want to take these two fears, the fear of running out of money and the fear of a market drop, and show you how to reduce them. I want to help you build a framework that puts you back in the driver's seat of your financial life. So what actually reduces this fear? What can we truly do first and foremost? Having a written financial plan, if there is one thing that could immediately reduce these fears, it is this. And the data is incredibly consistent in this area. Research from firms like Vanguard, Northwestern Mutual, and Charles Schwab shows people with a written plan are 2 to 3 times more confident, and they are more likely to stay invested during downturns. But here's the problem. 48% of Americans do not have one, so just solving for this alone could materially improve both stats. But here's another problem. Most Americans do not actually know what goes into a financial plan, because according to that same Allianz survey that we referenced at the start of the video, many do not know how to plan beyond just saving. Contributing to a retirement account is a great start, but beyond that, you also need a target retirement number, a timeline. You need a timeline for when you actually plan to retire, as well as a timeline for how long you think that retirement will last. And you need a distribution strategy. How does this money actually turn into income? What does this plan truly look like? Is it a monthly paycheck? Where is your emergency savings? How are you covering the gap? This is really how you turn savings into a plan. Allianz also said most Americans do not know how Social Security fits in. If you have not done so already, go to the Social Security Administration's official website, ssa.gov, and create your free account. Once you log in, you will be able to see your work history. You will be able to see what your projected benefits are at different ages. Everything from early retirement age 62 to full retirement age or age 70, and this can help you decide when you are going to claim, because this is going to serve as your income floor. This is what comes in every single month regardless of what the market is doing, and this is an incredibly important piece of this puzzle because this shows you what your portfolio actually needs to cover. It shows you that your portfolio does not have to cover 100% of your spending. Allianz also said that most Americans do not know what taxes look like in retirement. This is one of the biggest unknowns and one of the biggest misconceptions. Here is the reality. Research from the Center for Retirement Research shows the majority of retirees pay no federal income taxes. And we see a clear trend. About 80% of households pay federal income taxes in their peak working years. That drops to about 50% by the age of 65, and by the age of 70, it drops to about 35% of households. Why? This is because income often declines in retirement. Social Security is partially tax-free for many. There is no payroll taxes, and many states have more favorable tax rates where they eliminate or reduce taxes from retirement accounts. For many retirees, taxes fall dramatically once they go into retirement. But remember, not everyone fits this pattern. If you have very large traditional account balances, if you have dual Social Security benefits or a pension, you might not fit into this picture. In fact, you may find that you stay in the same tax bracket or move even higher over time. So what is most important is that you know your situation. Another big blind spot is knowing what healthcare will actually cost. This is one of the biggest sources of uncertainty, and truly one of the hardest categories to accurately estimate on your own. Another way we can really help to combat these fears of running out of money or fearing a market downturn is thinking in terms of income-based planning versus portfolio-based thinking. This is a really big one, and it is supported by research from David Blanchett and Michael Fink. When retirees think in terms of I have a $400,000 portfolio, they often feel a lot of uncertainty with that because a portfolio itself feels abstract. It is hard to think of a portfolio in terms of what will my life look like in retirement? What kind of life would that support? But if we shift our thinking to thinking in terms of income, specifically guaranteed income as well as discretionary income, well then all of a sudden things feel a little bit more concrete. Let us run through an example. Let us assume we have a dual income household. One person receives $1,600 a month in Social Security benefits, and the other receives $2,500 a month. That is $4,100 a month in guaranteed income. So no matter what the market does, those checks show up every single month. Now let us say this household also has $400,000 invested at a 5% withdrawal rate. That gives you $20,000 per year, or about $1,700 per month. That becomes your flexible income. This is the part that you can adjust. Maybe you spend a little bit more when the markets are doing well, and maybe you pull back a little bit when the markets are down. Now think of how different that feels. In one scenario, you say, I have $400,000. What kind of life can I have? In another, you say, I have $4,100 a month in guaranteed income plus about $1,700 a month in flexible income. That gives you a real picture. That is something you can truly plan around, and it is very easy for us to work with monthly income figures after all. We have been doing this our entire working lives, and this is exactly what the research shows. When people frame their wealth as income as opposed to assets, they experience more stability, more control, and more confidence. And more importantly, they feel less anxious and more comfortable actually spending their money. The next thing you can do is understand safe withdrawal flexibility. One of the biggest fears that looms over pre-retirees' heads is, what if I retire and suddenly the market drops? All of a sudden, everything I worked so hard for, my retirement plan, completely breaks. But that is not how a well-designed retirement plan works. Research from Morningstar, Vanguard, and Michael Kitz's shows the 4% rule is a conservative baseline based on rigid inflation, adjusted withdrawals, but real-world retirees are not rigid. When you introduce even basic flexibility, starting withdrawal rates can increase to about 5 to 5.7%, and long-term success rates improve significantly, and this does not mean dramatic lifestyle changes. In many situations, it is as simple as skipping an inflation raise or reducing your pull from your portfolio by 5 to 10% temporarily. Let us use our previous retirees who had that $400,000 portfolio. Let us say you are withdrawing $1,700 a month or $20,400 for the year. Let us say you reduce that draw by 10% during a market downturn. So now you are pulling $1,547 per month or $18,560. $4 a year, that is a reduction of about $1,800 per year. That is about $153 a month. We are not talking about a massive change. If we look on its face, this does not even feel like much. And remember that this household would still have guaranteed income streams like Social Security coming in every single month. But when we make small adjustments like this in the times where it matters most, research shows us that this can have a long-term outsized impact on the success of our portfolio. Adjustments like this can improve success rates by 10 to 20 plus percentage points. It can preserve tens of thousands, maybe even $100,000 or more in portfolio value, and it can extend the life of a portfolio by years. The benefit is not really just about the dollar amount. It is about when you make the change, when you reduce your draws when the market is down, when your assets are depressed, you avoid selling when it could do the most damage to your portfolio instead of locking in losses. You give your portfolio time to recover, and more importantly, this gives you a specific plan that you can follow should this situation happen when you retire. And having a plan is everything, so you know exactly what to do. So the bottom line is making these small temporary adjustments can result in a permanent improvement in your portfolio. Number 4 is building a cash buffer. This is your sequence risk protection. This is one of the most practical ways to reduce anxiety in retirement, and the idea is very well supported by research. You want to have anywhere from, say, 3 to 5 years worth of cash at the ready, whether that is held in a money market fund, CDs, T-bills. So it is readily accessible. What this does is it eliminates the need to sell investments during a downturn. It protects you from sequence of returns risk, from having to draw on your investments early in retirement if you retire in a down market. And it turns market drops into really a non-event for you because you are not touching your portfolio. So instead of thinking, oh my goodness, the market is down, what am I supposed to do? You get to say, oh, the market is down, it is okay. I do not even need the market right now anyway. But this might also lead to you thinking, how am I supposed to build a cash buffer that is 3 to 5 years worth of expenses? Well, the good news is you do not have to cover all of your expenses. You only have to cover the gap between your necessary spending and your guaranteed income streams. Let us go back to our dual income household. They have $4,100 a month coming from Social Security. This is our guaranteed income. Then they want $1,700 a month from their portfolio. That is $1,700 a month. That is the gap. So instead of building a cash buffer that covers total spending, you are only building a buffer that covers the gap. So in this situation, a 3-year buffer looks like about $61,200. Now, sure, that is not insignificant, but what this does is gives you multiple years where you do not have to touch your portfolio. You do not have to sell during the downturn, and you can give your portfolio the time it needs to recover. Number 5, we want to allow Social Security to serve as our foundation. Look at it as our income floor. This is one of the most underappreciated stabilizers in retirement. According to data from the Social Security Administration, low earners experience about a 75% income replacement from Social Security. Middle income earners tend to fall in the ballpark of about 40% as an income replacement. And if we look at married couples, they see income replacement for the household level of about 62% of income. If we look at households without a pension, these are not trivial numbers. And once people truly understand what their projected benefit looks like, They can plan out when they should actually claim, and they can figure out how Social Security fits into their whole retirement income picture. And this changes everything because now you know your portfolio does not have to carry the full burden. And then it is important that we also layer in two realities. Many retirees spend less in retirement than they did while working, and Social Security can cover a meaningful portion of income, especially for lower and middle income earners. All of a sudden, that gap you need to fill from your portfolio starts to feel a lot more manageable. For instance, if you expect to live on $60,000 a year in retirement and you know you only need to cover 20% of that gap from your portfolio, or about $12,000, that feels a heck of a lot more manageable than thinking you have to cover the entire $60,000 from your portfolio. Truly, for most Americans, Social Security is the income floor that your entire retirement plan ends up being built on, if you take everything we have just walked through and actually put it into a plan. First and foremost, having a written financial plan, having clear defined income floors, looking at Social Security, perhaps a pension or an annuity, having a flexible withdrawal strategy, you know exactly where and how much you will cut in a market downturn, and having a 3 to 5 year cash buffer, which lets you know that you have money set aside ready to turn to if needed. The experience of retirement changes completely. Now, if you experience a market drop, that does not feel threatening because now you simply turn to your plan and you know what steps to follow. You already know where your income is going to come from, how much you can adjust, and what you are not going to touch. So to answer our question at the top of the video, what could realistically improve these stats that we referenced? If we strip everything down to the highest impact actions, it comes down to 3 things. Number 1, get people to create a written plan. This alone can dramatically reduce fear because uncertainty tends to disappear when you have a clear, actionable plan. Number 2, shift the conversation to income, not assets. Start asking, what income does this produce? Know exactly what your guaranteed income streams are, as well as your more flexible income streams are. This tells you exactly how much give your plan has, and this alone can reduce anxiety and increase spending confidence. And number 3, teach flexible withdrawal strategies and have a downturn playbook. You have to have a plan for what you are going to do if the market does not cooperate. As long as you have a plan with the steps you can follow, that goes a long way to building confidence, to giving you peace of mind when you give someone a clear plan, when to adjust, how much to adjust, and for how long. It has a way of channeling all that panic into, okay, these are the steps I need to follow to succeed. 67% of Americans are afraid of running out of money more than death, but the data tells us that it is because they do not know how their plan works. Because once you understand what you can spend, what exactly happens in a downturn, and you know exactly where your income is coming from, all of this fear becomes much more manageable. At the end of the day, it is very hard to manage what you do not understand. So this is why it is so important to understand your money so you can take control of your life. I do not want you to be more afraid of running out of money than you are of running out of life. I want you to feel confident with your money so you can enjoy everything you have worked so hard for. So what are your thoughts on these stats? I would love to hear. Leave a comment down below. I post new videos every single week if you got anything at all out of this one. Please give it a like. If you are new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I will see you soon. Bye.